For decades, Europe wrote the rules. They drew the borders, set the prices, controlled the ports, and dictated what Africa could sell and what it couldn't. Gold, oil, coffee, cobalt, all extracted from African soil, refined in European factories, and sold back to Africans at 10 times the cost. That was the old world order. That was the silent contract of global trade. But not anymore. Because right now, as you watch this, that entire system is collapsing. A single signature in Addis Ababa changed everything. It wasn't a war. It wasn't a coup. It was a pen on paper, a trade deal so massive, so historic, that it sent shockwaves through stock markets in London, Paris, and Berlin. For the first time in modern history, Africa didn't just join the game, it changed it. Across Europe, analysts are calling it the economic earthquake no one saw coming. Because what began as quiet negotiations between African nations has exploded into a $5 trillion trade alliance, the largest economic partnership ever built by the Global South. And guess who's not invited? Europe. It's the kind of headline that makes old empires nervous. Africa cuts Europe out of new global trade network. In Brussels, trade ministers are panicking. In Paris, policymakers are scrambling. In Berlin, industry leaders are holding emergency meetings because the foundations of their economic dominance are starting to crack. Europe built its power by controlling Africa's markets. But now, Africa's markets are uniting and turning eastward to Asia, the Gulf, and even South America. This isn't a symbolic gesture. It's a seismic shift in how the world's wealth flows. Imagine this. You wake up tomorrow, and 1.4 billion people, the fastest growing population on Earth, decide to trade, manufacture, and sell goods without needing the euro or the dollar. No more middlemen. No more European tariffs. No more waiting for IMF approvals or aid packages tied to foreign conditions. That's exactly what's happening. Africa's new trade alliance is rewriting the global rulebook, linking economies from Lagos to Nairobi, from Cairo to Cape Town, and beyond. It's not just about raw materials anymore. It's about value. Steel plants in Egypt, car factories in Morocco, lithium refineries in Zimbabwe, tech hubs in Kenya, all connected under one system. A system that doesn't rely on Europe. Let's rewind for a moment. For centuries, Africa's economy was shaped by extraction. Resources left the continent, but the wealth never stayed. Even after independence, trade laws, shipping routes, and payment systems remained in European hands. Every transaction flowed through Western banks, Western insurance, and Western approval. Africa didn't lack talent or resources, it lacked freedom in trade. But in 2025, everything changed. African leaders, tired of being price takers, came together under one vision: to control their own markets, trade directly with the world, and use African currencies to do it. The result? A trade pact that connects 54 nations, the African Continental Free Trade Area, or AfCFTA, now expanded with new partners in Asia and the Middle East. The total trade potential? Over $5 trillion. The headlines in Europe were brutal. Africa turns its back on the EU. European supply chains in crisis. Global markets rattled by Africa's trade bloc. But inside Africa, the mood was electric. This wasn't isolation. This was liberation. Factories are buzzing, startups are rising, new ports are being built from Ghana to Tanzania. For the first time, goods made in Africa are being shipped, traded, and consumed across Africa, and the profits are staying home. One African minister said it best: "We've stopped exporting poverty and importing debt." To understand how shocking this is for Europe, you have to remember, Africa wasn't supposed to move this fast. Western economists predicted development would take generations. They said Africa couldn't unite. They said corruption, conflict, and poverty would always keep it dependent. But they were wrong. Because while Europe debated carbon taxes and sanctions, Africa built railways, energy grids, and digital trade platforms. While Europe hesitated to invest, African nations welcomed Asian and Gulf investors. And while the West kept calling Africa a developing region, the continent quietly became one of the most dynamic markets on Earth. Now, the balance of power is shifting. Europe once dictated prices. Now Africa dictates supply. European automakers, steel companies, and food producers all depend on African raw materials: cobalt, nickel, cocoa, lithium. But with the new trade deal, Africa can decide who gets access, and at what cost. It's not revenge. It's reality. And it's shaking the foundations of the global economy. In just weeks after the deal was signed, the euro slipped, commodity prices spiked, and European corporations reported sudden cost surges. Because when Africa moves, the world feels it. Economists are calling this the beginning of a new economic era, the rise of the global south. And at the center of it all is Africa, the world's youngest continent, with the fastest growing labor force and the richest natural reserves. This is more than a deal. It's a declaration, a message to the world. We are not Europe's suppliers. We are global players. For the first time in modern history, Africa isn't waiting to be invited to the table. It's building its own. And the world is watching. Because when a continent this rich, this young, and this united makes its move, the entire global order shifts. For more than a century, Europe controlled Africa's trade by design. From the Berlin Conference in 1884 to the World Trade Organization meetings in the 1990s, the same pattern repeated. Africa supplied. Europe decided. European shipping companies carried the goods. European banks cleared the payments. European markets determined the prices. It was a system that worked beautifully for Europe. Each time Africa tried to industrialize, someone warned of economic instability. Loans came with strings attached. Factories were discouraged. Exports were encouraged. The cycle ensured that Africa's raw materials fueled European prosperity, while African economies remained dependent. But Africa's demographics changed the game. A new generation of leaders, born after colonialism, educated globally, and unapologetically ambitious, saw that dependency for what it was, a trap. They wanted more than aid. They wanted agency. So, they began to act. From Accra to Nairobi, from Cairo to Johannesburg, governments started building regional railways, new power grids, and local manufacturing plants. They built digital customs systems, new ports, and fintech platforms that made trade smoother within Africa itself. And slowly, Europe's monopoly on African trade began to crumble. The turning point came in 2025. After years of quiet negotiation, 54 African nations gathered in Addis Ababa to finalize what economists now call the deal of the century. It wasn't just another trade pact. It was a continent-wide economic blueprint. The African Continental Free Trade Area, or AfCFTA, now expanded through partnerships with the Gulf, China, India, and Southeast Asia. This expansion created a combined trade zone valued at over $5 trillion. In one move, Africa connected its own markets to the fastest-growing economies on Earth, bypassing Europe entirely. The signatures barely dried before the effects rippled outward. Shipping routes shifted. Currency exchange systems were recoded to accept local African tender and digital settlements. Investors from Dubai, Shanghai, and Mumbai began signing billion-dollar logistics and infrastructure deals. The new routes bypassed the Suez bottlenecks, bypassed European insurers, and bypassed Western banks. For Europe, that was an earthquake. Suddenly, African exports didn't need to go north to reach global buyers. They could go east directly. Africa's decision wasn't impulsive. It was a response to decades of frustration. Reason 1. Europe's new carbon border adjustment tax. It penalized African exporters for not meeting EU emission standards, even when African products were cleaner than European alternatives. Reason 2. Europe's hesitation to invest in real industry. When Africa asked for partnerships in technology and manufacturing, Europe offered lectures on governance and credit scores. Meanwhile, Asia offered factories, capital, and respect. Reason 3. Europe's political tone. Many African governments grew tired of being told what policies to adopt before receiving access to markets. When negotiators realized Asia and the Gulf required no such lectures, the decision became easy. So Africa pivoted decisively. In Paris, headlines screamed, "Africa slips away from Europe's economic orbit." In Berlin, auto manufacturers called emergency meetings. Africa's cobalt and lithium supply was now being redirected toward Asian EV producers under the new alliance. That meant Europe's electric car revolution suddenly faced shortages and higher prices. The euro dipped. Stock markets wobbled. Politicians promised to re-engage with Africa, a phrase that sounded more like panic than policy. For the first time, Europe realized it could not take Africa for granted. Within Africa, the transformation was profound. New trade corridors linked Lagos to Nairobi, Dakar to Dar es Salaam. Customs duties between member states dropped by as much as 90%. Digital trade platforms handled millions of transactions daily in African currencies. This wasn't theory. It was happening. In just 1 year, intra-African trade rose 30%. African manufacturing output grew faster than at any point in modern history. Billions of dollars that once leaked overseas began circulating locally. A new class of African investors emerged: financiers, engineers, digital entrepreneurs, reinvesting profits into African businesses. The psychological shift was even bigger. Africans began to see their continent not as a collection of dependent states, but as one vast economic powerhouse with its own rules. Europe's initial reaction was denial. Officials framed Africa's pivot as temporary, a phase. But by 2026, even European media began acknowledging that the continent had underestimated Africa's capacity. The European Union tried to counter with a new initiative, Global Gateway Africa. But African analysts quickly noted the promised investments were smaller, slower, and buried in paperwork. Meanwhile, Asian cargo ships were already docking at African ports built with African and Gulf financing. The West moved with memos. The East moved with money. And Africa made its choice. The map of trade routes looks nothing like it did a decade ago. New rail lines connect the Atlantic to the Indian Ocean. High-speed fiber links financial hubs from Cape Town to Cairo. And a growing digital payment network allows African nations to trade without touching U.S. dollars or euros. Analysts call this the de-Westernization of global commerce. Europe still matters, but it's no longer the center. Instead, the gravitational pull of trade has shifted south and east. The BRICS bloc, now expanded to include major African members, controls more than 40% of global GDP. Europe's share continues to shrink. In Ghana, a young entrepreneur exporting solar panels says, 5 years ago, I needed a European partner to sell my products. Now I ship directly to Asia and within Africa. My profit tripled. In Kenya, farmers use regional e-payment systems to sell produce across borders without foreign banks. In Nigeria, engineers build automotive parts once imported from Europe. Each success story chips away at a century of economic imbalance. The United States calls the alliance an opportunity for balanced growth. Privately, Washington worries that Europe's decline in Africa will push African nations further into the orbit of China and the Gulf. China welcomes the change. Its companies are already investing billions in African manufacturing, logistics, and energy infrastructure. Even Latin American nations are joining the new trade network, seeking to link their agricultural exports with Africa's industrial demand. The result? The Global South, once a term of poverty, now represents the fastest-growing and most resource-rich bloc on the planet. Europe now faces an uncomfortable truth. The same continent it once lectured now negotiates from strength. To secure resources, Europe must compete on equal terms. To sell goods, Europe must offer technology and fair pricing, not conditions. Some European firms are adapting quickly. They're forming joint ventures with African companies, shifting manufacturing plants to Africa itself. Others cling to the past and risk extinction. As one African commentator put it, Europe didn't lose Africa overnight. It lost Africa every time it ignored our voice. This trade deal is more than economics. It's a statement that Africa will no longer be defined by extraction and dependency. 1.4 billion people, dozens of nations, one vision. Trade on equal footing with the world. Europe's grip has loosened, not because of anger, but because of evolution. Africa has grown, stronger, smarter, connected. From cobalt mines to fintech apps, from railways to renewable energy plants, Africa is positioning itself as the backbone of the 21st century global economy. The old world order, where the West dictated and the rest obeyed, is fading fast. The new order is multipolar, digital, and driven by Africa's rise. And as markets tremble and headlines scream, one truth becomes impossible to ignore. The future of global trade is being written in Africa. Music swells, montage of African skylines, ports, and innovation centers. This is the dawn of a new chapter, the narrator says softly. A chapter where Africa no longer waits for opportunity. It creates it.